Hello, everyone. Welcome to Conversations with the Fed. Thank you for joining us. Today we have Joe Mahon and Ron Wirtz from our regional outreach staff here at the Minneapolis Fed. They're here to tell you about what the Fed is doing about the pandemic and the effects of COVID on the regional economy. I'll turn it over to Joe.
Thanks, Carmi, and thanks everybody for tuning in today to hear from myself and from Ron. We're going to spend most of this hour hearing from Ron about the economic impact of the COVID-19 pandemic, particularly on the 9th District economy. But we thought it would be a good idea to sort of tee up that conversation with a bit more background on what is the Federal Reserve actually doing with this information in terms of our policy response, to kind of put in context why this information is useful. And so I wanted to just give a quick, very high-level overview of the Fed's pandemic response and the policies that we've put in place to help ameliorate some of the effects on the economy. Real quick, before I get into this, I just want to make clear for both Ron and myself that any opinions we express today are those of ourselves and not necessarily the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So as I mentioned, I'm going to do a very high-level overview, and if there are more questions about this or if there's a lot of interest, maybe we'll do a future event that focuses in more detail on some of these matters. But just to kind of give a brief overview of, first, what are the Federal Reserve's powers in emergency to intervene in the economy and to make credit available? And then I'm going to talk, after introducing the legal authority that we have, what we've actually been doing during the COVID-19 pandemic, and with a particular emphasis on the new programs that we've put into place that are specific to the pandemic and its effects on the economy. And then finally, I'm going to wrap it up with just a little bit of information about our monetary policy response. That's what we're best known for, the influence of the supply of money and credit in the economy and interest rates. And so I'll just talk about that real quick at the end before turning it over to Ron. So a little bit of background on what exactly the Federal Reserve can do in emergencies. I have here the introductory paragraph to Section 13(3) of the Federal Reserve Act. That's where our legal authority to lend in economic emergencies actually comes from. There's a lot of legalese in the paragraph. I'm not going to read the whole thing. I've just highlighted some of the relevant words that I think really key in on the unique things that we're able to do as a central bank. A lot of times, this section of the Federal Reserve Act is referred to in the broad-based authority that it gives to the Fed to lend to a lot of different parties. But the words I'm keying in on here say as much about what the constraints are facing us and what we're allowed to do. And really, it starts with those first opening words, in unusual and exigent circumstances. So the Fed has the ability to lend freely, but really only in times of emergency, not in normal times. And so during emergency economic emergencies, the Fed has fairly broad authority to lend to a variety of institutions, not just to traditional commercial banks. But again, we want to make sure that we're lending against collateral. It's often interpreted in terms of loans from depository institutions or others that they're using to secure the lines of credit that they're drawing on from the Fed. But also securities and other assets the Fed can lend against. And really at the end, the really key important part, we want to make sure that the parties that we're lending to during emergencies are ones that are unable to otherwise secure credit through the private sector, and that it's a consequence of the emergency circumstances themselves and not necessarily due to poor decision making on their part. So we have this authority, and during the pandemic, we've been able to invoke this authority to establish a new set of liquidity programs. One thing that wasn't mentioned in that paragraph from Section 13.3, but that is mentioned later in that section is that we also need the approval of the Treasury Secretary to put these kind of programs into place. And so all of the emergency response programs that we've been taking that I'll be talking about today were approved by Secretary Steven Mnuchin. And I'm going to focus on three in particular: the Paycheck Protection Program Liquidity Facility, the Main Street Lending Program, and the Municipal Liquidity Facility. There are a number of other liquidity programs that we've put into effect. I have kind of a list of acronyms at the end. Some of them might be familiar to the Fed watchers in the audience as programs that we actually created in response to the financial crisis of 2007 through 2009. I'm not going to spend a lot of time talking about those programs, in part because those are, in a sense, kind of reactivations of older existing programs that we had. And also those programs are focused more on stabilizing financial markets. And I want to talk more about what we're doing to stabilize the real economy, if you will, the business community across the country. And the first program I'm going to get into is the Paycheck Protection Program Liquidity Facility. So the PPP you might be familiar with. It was one of the key components of the Federal CARES Act. That was the relief package that was passed by Congress in order to ameliorate some of the effects of the crisis economic crisis caused by the pandemic. It's a loan program that provides short-term loans to businesses in order to keep their staff on payroll during the shutdown phase of the pandemic response. This program was funded by Congress, administered through the Small Business Administration. The Federal Reserve hasn't actually provided any of these loans, which I should mention are also, they're forgivable loans. They can be converted to grants by businesses that don't end up laying off any of their employees. So the Fed's role in this is not to make any direct loans through this program, but we created the PPLF as a financial backstop. And the way this works is, while we don't lend directly to businesses through this program, we lend to banks and other institutions that are making PPP loans, and we're accepting those loans as collateral. So this will provide them with the liquidity that they need to continue doing business as normal and making other sorts of credit available while they're also holding these PPP loans on their books. A couple other things to point out about that program is that the PPP is a short-term program, and the total number of loans, the volume of the program, is capped by the CARES Act. It's quickly become apparent that there's a lot of demand for that program. And so in response, the Fed, in partnership with the Treasury, has created a facility called the Main Street Lending Program. This is a program that will be lending directly to businesses. As I mentioned, it's a partnership with the Treasury, and the idea is to reach those small and mid-size, in some cases large businesses that weren't able to secure PPP loans or that need additional credit. And importantly, we want to make sure that these are going to businesses that were already solvent heading into the financial crisis. They were already in good financial standing. And it's really only due to the pandemic and the collateral effects on the economy that have put them into dire straits. These are going to be 5-year loans. Borrowers can defer the principal payments on the loans for up to 2 years. They can defer the interest on those loans for up to 1 year. And the last program I want to talk about briefly here is the Municipal Liquidity Facility. This, like the Main Street Lending Program, is also a partnership with the Treasury. But the market that we're focusing on in this case is to support state and local governments, which have seen pretty severe impacts on their tax revenues as a consequence of the economic contraction. And so this program is meant to kind of alleviate some of those cash flow stresses in order to allow state and local governments to keep employees on the payroll, to keep providing the services that in some cases are more important than ever during this pandemic. And to keep that sector of the economy running. The last thing I want to get into before I turn it over to Ron is the monetary policy response that the Fed has been taking. So this is the more traditional lever of macroeconomic policy. When you hear about the Fed raising and lowering interest rates, we're talking about monetary policy. The Fed took very decisive action at the outset of the lockdown. to lower interest rates. The FOMC, which is the Fed's monetary policy making body, actually had an unscheduled meeting off schedule in early March and decided to dramatically lower the target range for the federal funds rate, that key interest rate that we target. And 2 weeks later had an additional meeting where they lowered that target all the way to the bottom end of the range. So there was an immediate response. They didn't wait for their normally scheduled meeting to do that. Additionally, the Fed has continued and ramped up its asset purchasing program, purchases of treasuries and mortgage-backed securities to put further downward pressure on longer-term interest rates. The Fed funds rate is a short-term overnight interest rate, in fact. And then probably most importantly, because the effects of monetary policy have so much to do with people's expectations about future policy, the FOMC has tried to be very clear that policy is going to be accommodative and continue to be accommodative for a long time into the future until we're confident that we're well on the road to economic recovery, so that people don't have as much uncertainty about whether the Fed is going to change its stance and unexpectedly raise interest rates and tighten policy. The FOMC is trying to communicate that we're going to let our policy be guided by economic conditions. And so people have the same set of expectations that they're working on. So that's kind of the overview, very quick, high-level overview of the Fed's response to the COVID-19 pandemic. But now I want to turn it over to my colleague Ron to talk more about what we're learning about the effects that pandemic is having on the economy, what's caused it to take some of the responsive measures that we have. And I'm going to wait until the end to take questions just so we can get into Ron's material right away. Thank you.
Just want to say thanks to Joe for that overview. Again, he's covering more of the overview of what the Fed is doing in response to COVID. I'm going to try to share more about what we know about the COVID economy, how has it been affecting in the 9th District, and how is it different across the 9th District, and how we can explain about what's going on. So we're going to talk about the data challenge, about trying to track the COVID economy. Then I'm going to talk a lot about how we are getting a pulse via surveys. I don't think anyone needs me to tell them that things with COVID right now, the conditions are very poor, but they are less bad in some sectors and places, and workforce effects have not been evenly distributed either. Then I want to talk about some new measures for the COVID economy. So we're trying to track COVID in a very different way because of those data challenges that I'm going to talk about. Okay. And while I have a group here of over 100 people, what we always like to do too is ask the people that we're in front of. I often give talks to business groups, and what happens with that group is I want to take some information from them. They are as good a pulse as I can get in terms of finding out more about what's happening with businesses on the ground during this COVID economy. So I'm going to have an interactive survey kind of interspersed with some of the slides here. And I'm going to ask you some questions that will help us understand what the audience right here, right now, feels in terms of the COVID effects. In order to do that, I need everyone to log on. This is a cell phone-based survey, so I'm hoping everyone will participate. So I need you to get your phone, okay? And I need you to send a text to this number, 22333. And I need you to text the word Minneapolis. And if it capitalizes, that's just fine. And then I need you to hit send. All right, so here's a practice question. So this will also help us understand kind of who's on the call, and it'll help me understand for later questions. The audience is going to get a little bit better idea of exactly how people are responding, given maybe whether they're employed in business or nonprofits or government, or maybe they're unemployed, student, retired. So this helps us understand who our audience is here. And thankfully also the technology is working. Okay, so I'm going to move forward. So it looks like we have a lot of private business, a lot of people employed here, so that's great. So here's the data challenge with COVID. So when I would normally give a talk, and let's say I was giving this talk at roughly, say late February, I would often start with this chart, which is a real basic chart of gross domestic product, basically the economy's output. And this is the most recent data we have. And here what you see, the dark black line, is the US, and what we only have is the first quarter of 2020. For states like Minnesota and Wisconsin, we don't even have any data for 2020 yet. The last figure available is the fourth quarter of 2019. So if you happen to be on the moon and not paying any attention to the actual economy here on Earth, you wouldn't even know that from this measure, from our kind of our most base measure, that we were even in the COVID environment right now. The most recent GDP figures for states are 6 months old. In terms of unemployment, data is a little bit better. Here's the rate right before we hit COVID, all below 4%. In 1 month, we shot up to a level that was above Great Recession levels. In May, we saw a little bit of a downward trend in many states and the US. We did see a slight uptick in Minnesota, I think in part because it was, I don't want to say artificially low, but I think our data systems have not really been designed to try to measure the speed of what's happening in labor markets that we've had in COVID. So I think there's going to be some jostling around in terms of unemployment figures. And I think right now we're starting to see that happen already with May figures. But part of the point too is that these figures only came out a week ago or so. And we won't get another batch of unemployment data for about 3 weeks. So during this time of really volatile labor markets, we are really in a spot where we're trying to feel in the dark a little bit for what's happening. So the challenge is that the speed of the pandemic, we really need more real-time information. A lot of the macro data is time-lagged, and it's frankly just less COVID relevant. So how are we filling that gap? We're doing more outreach, and we're also collecting new data. I'm going to first talk about a lot of our survey work. So in regional outreach, the department I work for in public affairs, we've done 9 surveys since mid-March, and through those surveys, which I'm going to talk more about, we've gotten almost 7,000 business responses and 20,000 open comments, which really give us a real granular feel for how businesses are responding and affected. The Center for Indian Country Development also has done some survey work with tribal governments and tribal enterprises. I'll talk briefly about that. Community Development and Engagement has done a lot of outreach to CDFIs. And then the Opportunity and Inclusive Growth Initiative has actually started a really interesting nationwide consumer survey that I'll just touch on briefly. So the main thing I'm going to give to you today is a business survey that we did in May, and this is a survey that I've done 3 times now all together. Okay, the most recent one is in May, and we got almost 1,100 responses across the 9th district, roughly the Upper Peninsula, Michigan, Western Wisconsin, Minnesota, the Dakotas, and Montana. Now, what I want to say up front is that this is a snapshot of general conditions. Because we didn't sample these in a scientific way, we can't say that our responses absolutely represented the general population of businesses. But with 1,100 responses, I feel like we have a really good snapshot of how businesses were affected. There are lots of ways to splice that data on who's impacted and to what degree. Mostly we were able to split a lot of this down by firm trait. So I'm going to talk about some geography traits. I'm going to talk about industry sector, business size, and ownership structure. In general, the main takeaway is that COVID effects have been very wide and very deep and negative, but there's also variation across those groups. So the base question that we wanted to find out is, excuse me, is what has happened to sales and revenue? And when we asked in May, we had to ask about April sales and revenue compared to 2019 levels. And from a regional standpoint, excuse me. Sorry about that. So what I wanted to show from a regional standpoint is that the Upper Peninsula, Greater Minnesota, and kind of on down with different states is that we have seen some geographic differences in terms of the impact. The more red the bar, the more negative the impact. So this is lower by 75% of revenue or more compared to last year. So first thing I would show you is that everybody has seen very significant impacts regardless of state. Okay, but there are some regional differences. So geography does matter, but I'm also going to show you some additional ways of looking at the data that shows that geography matters less than this chart might suggest. So one of the things we asked about is we wanted business respondents to identify what sector they were in. And what you see is that there's also significant impact kind of across the board, but some have been impacted much worse than others. So those that are consumer facing, those that deal with a lot of crowd-based businesses, a lot of face-to-face interactions, those in entertainment and lodging and retail, those have been the most hard hit with regards to revenues. And going back to the last slide with regards to geography, one of the reasons South Dakota's percentage impact was lower comes in part because it had a larger number of respondents in some of the sectors that have seen less of an impact, like manufacturing and banking. So if you were to kind of overlay some of these results, what you'd see from a geography standpoint is that some of those results are compressing so that geography matters less. It doesn't mean it doesn't matter at all, but it matters less. We also asked about firm size. So we asked them to identify how many FTE employees they had. And what you can see here is a very clear relationship to size. So the larger you are, the smaller the impact on revenues. Okay, so sole proprietors, 70% have seen cuts in revenue, 70% have seen revenues cut in half or worse. And for the largest firms, it was 25%. Now, 25% is still a dramatic number. If you didn't know anything else, that's a catastrophic number for the economy. Just unfortunately, the smaller firms have seen even more negative impacts. We also asked about ownership. So the federal government identifies disadvantaged firms as minority-owned, veteran-owned, and women-owned. And what you see here again, all firms are having impact, very negative impact. But we are seeing that those disadvantaged ownership firms are seeing more of a negative impact. But again, in terms of thinking about different traits, these disadvantaged firms also tend to be smaller, and they tend to be in harder hit sectors like food, lodging, entertainment, and retail. So the Center for Indian Country Development has also done some survey work looking at tribal governments and enterprises. And I just wanted to show real quick that we're seeing kind of the same thing that the economy in general is seeing, in that both tribal governments and tribal enterprises, casinos, and lots of other kinds of tribal enterprises are seeing very significant impacts on revenues. This one is from April, okay? And here you see that these lines right here is that we're seeing in roughly 30% of enterprises have seen 100%. When casinos close, they have no revenues. So we're seeing a very dramatic impact on tribal governments and enterprises. The Minneapolis Fed is also going to be gauging impacts among local governments and K-12 school districts in Minnesota in July. Just wanted to make a note of that kind of wherever the economy has wherever we have to track the economy, whether it be in government, nonprofit, private business, we want to try to gauge what COVID impact we're seeing. So let's talk a little bit about Minnesota's workforce. We've been talking all about firms so far. Let's switch to Minnesota's workforce. So there's been a lot of information, a lot of news articles on unemployment insurance claims. So there's two things that I want people to focus on. There's continuing claims here. Okay, but first let's talk about initial claims. Initial claims are in the blue. Okay, and what we saw in Minnesota an increase of roughly 30 or 40 fold in terms of initial weekly claims. Luckily, they've been trending downward, but even here at roughly about 25,000 at the end of May, still roughly about 6 or 7 times what the normal level during this period we would normally be. Continuing claims are the ones that are approved and that are seeing actual benefits on a week-to-week basis. We see a similar steep increase, and what we've seen of late is that they've plateaued and look to be actually decreasing a little bit of late. Since mid-March, and I didn't update this, I believe we've actually seen probably closer to 750,000 initial claims. But what you see with continuing claims is that we're only at about 400,000. So in many ways, the initial claims that we read a lot about in the newspapers are not a great measure of unemployment. I think some of it is basically what it suggests is that there are many that are filing that are not receiving benefits, and it's probably for a number of reasons. Some of which there are eligibility standards that have to be met, so some just don't qualify. In other cases, we're seeing businesses hire back with a payroll protection program that required firms to have people on their payroll in order to get the funding. So I think we've seen some callbacks, and there are other reasons why continuing claims is really a number that I think is probably more important to follow as it relates to total unemployment. We also asked about layoffs in our surveys. I'm just going to give you the one from our most recent one across the district. And basically, what we're seeing, you would expect. There have been lots of layoffs among our respondents, but some workers in some sectors have been more impacted. Again, because we saw more negative revenue impacts in the food and lodging and entertainment and retail sectors, those are the ones that have had to lay off the most workers. Similarly, banking saw the least impact, and we're seeing fewer workforce cutbacks in that sector. Okay, so I promised that I would have some survey questions for you. Now I'm really interested. So this has been, the survey data that I gave you was from May. So we've gone a little bit more than a month since we last did that survey, and I'm interested to know a little bit more about what's happening with staffing at your place of work as well as your wages. Okay, so how would you describe staffing activity at your workplace overall during the pandemic? So are you trying to hire or add headcount? No changes, net loss? And for those that are either retired or not voluntarily not working, I understand that that's not applicable to you. So pretty good, pretty decent balance net. Maybe some things are changing here. For the most part, it looks like most are seeing stable employment, which in this environment, actually, I think is quite an achievement. So it looks on balance that maybe it's just a small net loss of workers in terms of our audience, at least. I would say I do a fair number of these polls with business groups, and it really depends on the audience that I'm in front. This is actually quite reflective of what I generally see with construction and some other sectors. I maybe see a little bit of a variation to actually still maybe hiring a little bit more. So we're also really interested in wages. The Fed obviously pays a lot of attention to wages, and I'm real curious to know what you've seen. We've heard about wage cuts. We've also heard about wage increases, particularly for those that are maybe on the front lines at retail stores, at the Walmarts of the world, where they're actually getting rewarded for the hard work that they're doing. Because in this environment, we really have seen a lot of, I don't want to say mixed messages, but in the volatility that is COVID, there's just lots that's happening underneath the surface. And so it's really useful to hear from a big audience like this, what's happening to your wages. So it looks like we are seeing, and it looks like the A must be under 5%. So there's a little bit of balance. We are seeing some wage cuts. We are seeing some wage increases. On balance, most are not seeing any movement in their wages. So let's talk a little bit more about the workforce, about who's been affected. So the Minnesota Department of Employment and Economic Development does really offer some really great data on initial claims and who is making those claims. Now, again, to go back to that chart that I offered a little bit ago, this isn't a great explanation of who's unemployed. It only is an explanation of who has applied for who actually has applied for unemployment. So it is a good measure, at least, of some initial separation from work. And there's two measures on some of the charts that I'm going to show here. Here you have the absolute numbers on the left-hand side for the left-hand chart, the 350,000. These are absolute numbers. And then on the right, the chart on the right hand, I'm going to talk to you about initial claims as a share of that particular labor force. Okay. On this chart, we're talking about education, and those affected by layoffs have been disproportionately less educated. Okay. So on a number standpoint, what you see is that for the most part, there's been some balance, at least between high school diploma or less and some college, with fewer four-year degree being having applied for initial unemployment. Okay, then when you go to the share as a labor force, more than 40% of those with a high school diploma or less have applied for unemployment insurance, and that percentage of the labor force goes down significantly with more education. Those affected by layoffs are also disproportionately female and minority. Okay, so here you have the female and male, so a modestly higher number of female, okay, and the same here, but a higher share in terms of labor force as a share of total labor force. In terms of race, you see a smaller number of minority, a larger share of white workers, okay, but in terms of the total share of that labor force, the minority share is significantly higher. Okay, so layoffs are disproportionately affecting females and minority workers. I also took a little bit closer look at different minority groups, and basically the message is they're disproportionately affecting all minority groups, but especially among Black and Native American workers. So here you have initial unemployment claims by race. Here's the very large majority, non-white Hispanic, have applied. Okay, but that's because the large majority of the labor force in Minnesota is non-Hispanic white. So when you look over here and you look at the share, non-Hispanic white, 20% have applied. The Black share, 40% of all Black workers, or all 40% of the Black labor market has applied for unemployment insurance. So the Opportunity Inclusive Growth Initiative has also looked at this question a little bit more from a consumer standpoint, but real quickly, they've done a COVID impact survey that's nationwide. They've partnered with the Data Foundation, the Packard Foundation, and the Sloan Foundation, as well as the Associated Press. And their mission really to do this was that decision makers needed clearer information about the prevalence of coronavirus, as well as its impacts on the American people and our society. If you're not familiar with it, I would just Google the COVID impact survey by the Minneapolis Fed. I think there's a lot more to learn here, but I wanted to show you one chart. It kind of goes back to what I just showed you earlier. And here we have the reported employment rate by race, okay? And you have pre-COVID rates and April, May. And what I wanted to show you is you have the Minnesota white population here. Those are the blue and the red bars. The blue is pre-COVID, the red is April, May rates. And what you see from the respondents that are Black or other non-Latino is that they reported rates of employment that were higher than white respondents. During COVID, they reported employment rates that were notably lower than. And here, I think it's maybe just if I can take just a quick aside, because the disparity you see in some of these workforce outcomes with regards to the recession, these aren't frankly that unusual. We've seen these patterns in the past. And I feel like maybe we're finally ready now to look at the data honestly since the murder of George Floyd and the social unrest in Minneapolis. Maybe now we're ready to stop accepting the fact that there are lopsided and racist kind of distributional effects when the economy falters. We're not gonna stop recessions from ever happening, but I think we should expect that the negative effects of recessions, as well as the positive wealth that occurs when we're in a growing economy, I think we should expect that there's going to be more racial balance to that, particularly related to Black and Native American workers in the state who have historically faced the greatest disparities. For those that maybe aren't familiar, our bank president, Neil Kashkari, has been very outspoken about this issue. And this isn't really, it's not only the morally right thing to do, it's the sensible thing to do. For our long run economy, we need more workers participating in a meaningful and sustainable way. And by addressing some of these disparities, I think we finally capitalize on the huge human capital opportunity that minority workers offer the economy. So again, it's not only sensible, but it's long overdue, and we need to act on this. So with that, I'm going to probably transition a little clumsily back to some of my earlier points. And right now, I'd really like to talk to you about what the Minneapolis Fed is doing going forward. Because we still need to fill that COVID data gap. We need to do more survey work, and we're going to, and maybe we can talk a little bit about that in the Q&A session. But we also need to find better real-time measures of economic activity. So what we've been doing, there are a lot of people working on this. What we're trying to do is get a better data that helps us track not what happened last month or 2 months ago, but what happened last week or even yesterday. So I'm just going to show you a few charts. And what I want to point out is that we've created our own COVID-19 dashboard. You can find it at minneapolisfed.org, or you could just Google Minneapolis Fed COVID-19 dashboard, and you'll get not only a couple of these charts that I'm going to show you, but more of those, and we're constantly building a bigger and better mousetrap with regards to data. And what we find is that if it's important to the Minneapolis Fed and important to our decision making, I think it's important. We think it's important to also share that data publicly where we're able to, so businesses and consumers and residents have a better idea themselves about what's happening in the economy. Excuse me. So first, this is a chart on seated diners in restaurants. Okay, it's from a source called Open Table. So here, what you have is the activity pre-COVID. Then you saw everything go to zero when we went to shelter in place. And now what you've seen is that we're starting to see some activity as states reopen. Okay, but not all the same either. And we're getting this with less than a 1 week lag in activity. So much more current. Doesn't mean it's perfect. We don't have good measures in more rural areas for this particular source. We also can't get it in all states. We're also doing more tracking of auto and truck volume from the DOT. And you'll notice here the heavy truck in particular actually has managed to stay really close to par, which is kind of an interesting fact. And I think a little bit at least evident of why manufacturers have been able to stay a little bit more above water than some other industries. They've been more active. We also get TSA checkpoint travel numbers. We used to get airline passenger figures from the airports. We had to wait for them to get airline traffic numbers from all of the airlines. So we typically got it a month or two late. Now we're only on a 3 or 4 day lag in terms of getting TSA checkpoint, which is a really nice proxy for airline travelers. There's also a lot more data on job postings from Indeed. We've recently entered an agreement with them to get better job posting data from a regional standpoint. And as you can see, not every state is performing the same, but we're getting more recent data that I think helps us have a better idea where pivots are going to happen or the general overall trend of where things are heading. And as you know, everyone's carrying around cell phones, and there's a lot of data that's generated by those. And we're starting to get more data on where those phones are traveling. So here, there's just a measure of retail and recreation. So it basically can measure when and where people are going to businesses that relate to these sectors. Okay, and again, you're seeing different activity in different places. So lastly, getting towards the end of my formal comments, maybe 5 minutes or so, a couple of questions here. We're really interested in what is your current and future sentiment as a consumer. We do think that given the nature of the virus, consumer confidence is really going to be important, is really going to be an indicator on where we think the economy is going. So I would love to know from your standpoint, in terms of your consumer spending, how would you describe your current spending levels as a consumer compared to pre? So as we watch this populate, roughly I would say close to maybe where I would expect, again, with there's still being restrictions, people still being nervous about infection. I do think we've seen it in the data as well, that we're not really seeing normal levels of spending right now. And a few more coming in yet. So generally speaking, we're seeing moderate to well below, roughly 70% are not at their spending levels pre-pandemic. Certainly some of that is because people have lost jobs. Even within this audience itself, we would expect their spending to be lower. I think there's also just uncertainty, and where there is uncertainty, people are maybe less inclined to save, more likely to save, just in case something like that happens to them. What about your activity or mobility? Now, this is also one of those things that we're kind of interested in learning more, because mobility doesn't mean spending, but it does give us other indicators about confidence. So are you out and about as much as you were, or much less so? This is also getting to be an issue, I think, as you're seeing in other states, with regards to the places that you're going, whether it be the beach or parks, places where crowds are. We're kind of interested in what people's mobility is. And this one looks very clearly, this is a very conservative audience in terms of its mobility. Looks like most people have checked in. I'm not seeing a lot of additional answers coming in. So this is a more cautious audience with regards to mobility. And lastly, we're always interested in people's outlook. So there's lots of factors that go on this, and this is a very broad question. But what is your personal outlook on the economy through the end of 2020? The fact that there is any optimism, I'm glad to see. Looks like this group is a little bit less optimistic. And again, I've seen this vary considerably by audience. In the construction sector, there is still a fair amount of work. I've heard them be more nervous about RFP levels into the fall and later into the year, but now things are still relatively busy. But again, I think it's not unusual, given the level of uncertainty that COVID has introduced into all of our lives. If you think about it, we've been in this pandemic for a little over 3 months, and I'm sure it feels more like 3 years. And so that level of uncertainty is probably hard to be optimistic in the face of, especially if you're a business owner trying to make payroll and trying to make any profit. So looking ahead, again, as I mentioned earlier, you didn't need me to come onto your computer to tell you that COVID-19 has had a huge impact. The bank really doesn't, but there have been a lot of places and sectors that have seen differing impact. Where we originally thought we were hoping for a quick recovery, that doesn't appear very likely, at least short of a vaccine breakthrough and a ramp up of the delivery of that. And I think what the message that Bank President Kashkari has been saying is that there's going to be a more gradual recovery. That's more likely, and it's going to be driven mostly by consumer confidence, and that in turn is going to be driven, both negatively and positively, by the health and economic trends that we're trying to watch really closely at the Minneapolis Fed. That is the end of my formal remarks, and I believe, Carmi, if I can bring you back in here, I believe we're going to start the Q&A session. Before we do, I would just like to say thanks to everyone who spent time here. The pandemic is a very difficult thing for everyone, especially businesses. To those business owners out there, I just want to wish you luck. Even before we got into this environment, running a business is very tough, and running it in a COVID environment has to be tough times 10. So I just want to wish you luck. I want to wish everyone else good luck in trying to be resilient in this really tough time.
Thanks, Ron. Thanks, Joe. We are going to start the Q&A portion of the session. If you do have a question for one of our speakers, you can use the chat box, which you should find at the bottom of your screen. Please change the drop down in the to field so that it says to host, so that I can see those and ask those of Joe and Ron. While we're waiting for those to trickle in, you can see the slide that is on your screen indicates that Joe and Ron, as well as many other folks at the Minneapolis Fed, are on our speakers bureau, and they are available for virtual speaking requests right now. You can visit our website at the address that's listed there to make a request of Joe, Ron, or others. I'll also say, as I did at the beginning, if you do need to leave us early, when you leave the WebEx, rather than closing your web browser, if you could simply hit the red X at the bottom of the WebEx screen and leave your browser open, that will bring you to a quick 3-question survey about our event today, so you can let us know how we're doing. So I see there are some questions rolling into the chat, and also some questions about slides. In fact, it seems there's a big demand to get copies of both of your slides, so we can send a follow-up email to attendees tomorrow with links to the slides. I had a question that came in when you were, Ron, going over that COVID dashboard of some of those interesting, unique data sources that you're looking at. Are there any data sources in particular that you wish you did have access to that would help give additional insight into what's going on?
Yes, I can't think of anything, in particular. The thing I would say about the real-time data is I think we're only now starting to realize what's available. And that we just have to work a little bit harder on imagining the things that and the data that we would like. If you think about what's going on in the world, we have big data out there. There's lots of transactions and lots of other things that are being measured. The problem is most of it's very disaggregated, or it's behind, or it's privately held and is very expensive. We're just now really just starting to scratch the surface about those kinds of measures that we think are available, and then we have to go see where we might find it. And it's been really kind of encouraging for a lot of the data providers, private data providers that we've been approaching, that they've been very willing to share data with us. We've also been making more efforts to go to the state governments, particularly in Minnesota. There's lots of transactions that the state is tracking on an ongoing basis, and we've been in talks with numerous different departments to give us, whether it be sales tax transactions or vehicle related transactions. There are lots of things in lots of different entities that can give us a better picture for how the economy is performing. I would simply like to fast forward about 5 years from now, when I assume that our data collecting will be significantly better than it is right now, and I wish I had that data right now. So there's really no end to the number of things that I think in the future that we'll be getting that I would like right now.
If I could add to that, Carmi, I think there's also, I would like to be able to know a little bit more about finances at the household level. So we do a pretty good job tracking what's happening to businesses, and it's a lot easier to reach businesses in our surveys than it is to reach individual households. But obviously, a lot of the effects that we're seeing from the pandemic, and then the effects on the broader economy are happening through consumer decisions that are happening at the household level. And there's a lot more we could know about that, particularly more granular, whether people are losing their jobs and how that's affecting their spending, how much the extended and enhanced unemployment benefits that we've had under the CARES Act have helped. It'd be great to be able to say more about that, and we're working on that as well.
Thank you. There have been some questions about different states reopening at different rates, whether you've seen any cross-border effects of things moving from one state to another because it's more or less open, or how do we know who's got the right approach here in terms of reopening?
Joe, I'll let you go first on this one if you want.
Well, I think, and Ron made this point in going through some of the charts, particularly the kind of more timely, higher frequency data series that we're looking at. What's really striking is the similarity that we've seen across states, given how much we know about the different responses states have taken in terms of requiring shutdowns of businesses and other sort of shelter in place and social distancing measures. We know, for example, that South Dakota has been kind of one of the most laissez-faire states in the country in terms of those requirements. And yet, if you look at those series, you see at the outset of the pandemic, that mobility and a lot of the other indicators go down very, very quickly in response to that. And there's obviously been some differences in the recovery since then. But I think what's really striking about those is how similar they are, and it kind of underscores again the point that Ron made. That a lot of what we're seeing is based on is individual people responding to their perceptions of the risk from venturing back out, and that's very much a product of what's happening with the virus.
Right. So I would just add just a couple small things. First, while you did see some transfer of economic activity across borders, like Wisconsin opened up its bars and restaurants sooner than Minnesota, so you did see some traffic across the river from the cities over to Hudson and just into the near areas of Wisconsin. But on par, that's a really small percentage of economic activity. So I would say that's much more exception than rule. And for the most part, I think what we have to remember is that we're still really early in this pandemic. At least in terms of what we think is going to play out here. We've only been in this situation for 3 months, and lots of different states are taking lots of different approaches to this. And I don't think anyone can say they know exactly what the right approach is here. And so I think there's some utility actually to that I think there's lots of states experimenting with the right approaches in terms of trying to open up their economies. And we're going to have to be intellectually honest to say, to really gauge which approaches are the best. Again, balancing our clear economic needs. People have to work, businesses need to stay open, but we have to balance it with the real health risk that COVID presents. And so the fact that states are taking different approaches, I wish we knew that there was one strategy that all states could follow and it would automatically be the right one. I don't think we're there. So the fact that some states are taking slightly different approaches, I'm hoping in the long run, maybe be in 3-6 months from now, that we have a better idea what approach is the right one and that we start to coalesce around that strategy.
There have been a couple questions in the chat about what data you have on nonprofits specifically and how they are being impacted. And in particular, one person commenting that her spending has in fact increased during the pandemic because she is sending so many of her dollars to nonprofits. Do we have any data on that?
I would have to get back to you. If you were willing, whoever asked that question, if you might be able to send us a note via email. If I'm not mistaken, I'll have to go back to the data that I presented. I believe I did have a nonprofit sector in there. It was a very small respondent base, so that's why I didn't include it in the chart that I offered. So we do have some data, and our community development and engagement department might also have I think more information on that. Generally speaking, I think what I can say is that there's no sector that hasn't been impacted. The fact that it is dependent, the nonprofit sector is often dependent on charitable contributions and also government distributions. I think it's very safe to say that they've seen a very negative impact from COVID, much like all of the others. I also know that they've seen a significant increase in demand for service, whether it be things for base needs like food, shelter, things of those needs. I know that demand is also going up significantly. So I think it's very safe to say the nonprofit sector has seen the effects that most of the other sectors has been very, very significant and negative.
Are there any particular sectors or jobs that you think will be irrevocably damaged?
That's a great question. I hear this bantered about very often in the media. I guess what I would say is I don't think we know nearly enough to know what the future holds given how much things have changed already. So I think it's safe to say that those industries that have been really dramatically impacted, I think we're going to see change in those industries. I think they have to be thinking about different models in the case that something like this happens again. I'm unwilling to say what exactly is likely to happen because I don't know how many turns this virus is going to offer us before we finally see the light at the end of the tunnel. Joe, you have any thoughts on that?
Yeah, I guess I would say so. In normal times, when I speak about the economic outlook, I usually joke that that it's sort of the opposite of what you'd think, which is that the farther out you're trying to project, the easier it becomes. In as much as we know enough about the historical experience of economic growth since the beginning of the Industrial Revolution that living standards tend to rise over time, and so you can say pretty confidently that your children should be better off than you will be, and that over over a 10-year horizon, we'll all be probably wealthier than we are right now. And it's actually the shorter run that's harder to predict because it's anybody's guess what kind of shocks are going to hit the economy in the short run. But I think that when you're talking about the kind of big structural changes that people have in mind that COVID might induce in the economy, whether it changes work arrangements, whether it changes people's sort of fundamental habits and spending patterns, that's just really, really hard to predict.
Continuing along that line, though, Joe, do you see any opportunities in the midst of all of these challenges that maybe could help our economy come out stronger in the long run?
Yeah, I mean, I'm sure there are plenty of opportunities, business opportunities that are going to come out of this. I think if I knew what they were, then I might be in a different line of work. And so I'm not going to necessarily make any recommendations for what kinds of, what sorts of lines of business or opportunities you might go into. I do think that greater use of work from home is maybe going to change how we think about childcare and the way the childcare industry is structured. But again, fortunately, I have a lot of much smarter colleagues in our community development and engagement department that work in that sector and probably have much more interesting things to say about it than I do.
There's a question, Ron, about continuing survey work related to the recent civic unrest, and wondering if you have done surveys since then to gauge whether that's had an added impact, at least in the Twin Cities.
No, we haven't done anything since that May, but I will actually have a survey, both a general survey across the 9th District, as well as a survey for the Minnesota construction industry. So those will be going out in July, and we will be asking questions that ask about conditions since then. And we haven't actually constructed the survey. We'll have to think of some new questions. So exactly how we're going to ask, I'm not sure, but we are going to get not only a measure of how things have been since May, but whether or not the social unrest portion of this is how that's affecting their business as well. So you can, for any of the viewers out there that have maybe taken one of my surveys in the past, thank you. You'll be getting those, and I'm happy for you to spread that survey out to other folks, because it really is what I do is I organize those surveys through what I call gatekeepers, other business organizations that get out to their members, whether it be chambers of commerce or economic development associations or other kinds of business entities, and they send it out to their members. So the more the merrier. If you see it, let your friends know about it, let your other business peers know about it, because the more feedback we get on these things, the better.
Thanks, Ron. We're coming to the end of our time together, but if folks have time for just a few more questions, you can stay on. Otherwise, if you're leaving, when you close out of the WebEx, please take our survey. Ron, you had just mentioned the construction industry. There was a question about, is it lagging? Is it in denial? It seems like buildings are still going up, but who's going to move in?
Yep. Right. Well, I can't say anything about the moving in part. I can tell you about the supply portion, and so the latest survey that I did, which is about, it was in mid-May, and then I would say I've gotten more some additional anecdotal support since then. Is that what we've seen is that there have been a number of cancellations. So most firms have seen at least one project cancellation. About a third of them have seen more than just one or two. So there have been cancellations. There have been delays. What's happening, I think, is that there's been some pull forward in terms of demand. So construction firms are staying busy, and that's the good news. What I did hear very regularly through surveys, and as well as since that survey, just with contacts, is that construction firms are worried about what the fall looks like. They're seeing RFP, request for proposal levels, go down from what they're used to at this time of year. So they're a little worried about how full the pipeline is, or how full it will be come fall and leading into 2021.
Joe, you had mentioned wishing you had more data on specific household spending and household effects. There's a question in the chat about, do we have data on household credit card debt repayment, mortgage repayment? What are we seeing happening there?
Yeah, there are a lot of sources of data on those. In fact, some of them colleagues within the Federal Reserve have great access to lending information because of the our supervisor responsibilities over banks. So you can look at call report data, and there are private sources of data on those as well. I have to admit, I can't tell you. I wouldn't be surprised to know that that there are more loans going into default and that people are delaying payments on their outstanding consumer credit balances. But I couldn't tell you what the magnitude is offhand.
Thank you. We still have a number of questions in the chat, but I think we've touched on the broad categories that they fall into. So we'll take this moment to wrap up. Thank you to our speakers today. Thank you for all of those of you who've joined us today. Please fill out our survey. Let us know how we did. And if you're interested in having Joe or Ron or others of our speakers come speak to your group, please visit minneapolisfed.org/speakers-bureau. We will send a follow-up email tomorrow with the slides, so you'll have access to this presentation. Thanks very much for joining us.
Thank you.